Hello, and welcome back to AlgoBot, your friendly guide to the world of automated trading on MetaTrader 5. I'm AlgoBot, and today we're taking a close, educational look at an expert advisor called the Dual Boundary Rejection Hedge. This is a pure price action strategy, which means it uses no indicators at all. Instead, it maps out support and resistance from recent price swings, watches for rejection candles at those boundaries, and includes a built-in hedge plan for the moments when a boundary actually breaks. By the end of this video, you'll understand how it reads the market and how it manages each trade. Let's dive in. Let's start with the big picture. The Dual Boundary Rejection Hedge is built entirely around raw price action. There are no moving averages, no oscillators, and no momentum tools anywhere in its logic. Everything it does comes from the candles themselves. The strategy works in 3 layers. First, it looks back over a window of recent bars and records the highest high and the lowest low. Those 2 values become the resistance, or supply ceiling, and the support, or demand floor. By default, it studies the last 20 completed bars behind the current signal bar, and that look back is fully adjustable. Second, it watches for a rejection. Rather than chasing breakouts, this approach tries to fade the range. It waits for a candle that pokes into one of the boundaries and then prints a long wick, closing back inside the range. That long wick, often called a pin bar, suggests price tested the level and was pushed away from it. Third, and this is the distinctive twist, it carries a hedge plan. If the rejection idea fails and price closes decisively through the boundary instead, the strategy can open an opposing position in the direction of the break. The aim is to participate in the very move that invalidated the original fade. Because it reads structure directly from price, this expert advisor can be studied on many symbols and timeframes, though the concepts shine most clearly in markets that spend time ranging between defined levels. It's a thoughtful study piece for anyone learning how support and resistance, candlestick rejection patterns, and hedging fit together. As always, remember this is educational information only, not financial advice, and trading always involves the real risk of loss. Now let's walk through the exact logic, step by step. The strategy acts once per completed bar, using the last fully closed candle as its signal bar. First, it builds the range. It scans the bars sitting behind the signal bar, from 2 bars back out to the look-back depth, and records the highest high as resistance and the lowest low as support. While doing this, it also adds up each bar's high to low distance to find the average bar range. That average becomes a buffer, a small cushion around each boundary, scaled by the buffer fraction setting. Next, it inspects the signal candle for a long setup. 3 things must line up. The candle's low must dip into the support zone, meaning it reaches at or below support plus the buffer. The candle must then close back above support, showing rejection. The candle must close higher than it opened, making it bullish. And the lower wick must be large, at least the WickFraction of the candle's total range, by default half of it. When all of that agrees, the EA signals along. Entry is taken at the ask, the stop loss is placed just below support by 1 buffer, and the take profit is set by multiplying that stop distance by the reward ratio, which defaults to 1.8. The short setup is a mirror image. The candle's high must pierce the resistance zone. The candle must close back below resistance. It must close lower than it opened, and the upper wick must be long. When that pattern appears, the EA signals a short, with the stop just above resistance and the target again scaled by the reward ratio. Finally, the hedge. While a base trade is live, the strategy keeps watching. If a long fade was taken but the signal bar later closes below support minus the buffer, the support has given way, so the EA opens a short hedge at a larger size, set by the HedgeMultiplier. The same happens in reverse for a failed short. Only 1 hedge is deployed per cycle, and once everything closes and the account is flat for that symbol, the state resets and the search for a fresh setup begins again. Let's read the actual MetaTrader code on screen. At the top are the input parameters. RangeLookback sets how many bars define the boundaries. WickFraction sets how long the rejection wick must be relative to the candle. Buffer fraction scales the cushion around each level. Reward ratio sets the take profit distance as a multiple of the stop distance. HedgeMultiplier sizes the hedge, and lots is the base order size. Just below that is the send helper. It's a small router. If the order type is a buy, it calls trade.buy, and if it's a sell, it calls trade.sell, passing along the volume, stop loss, and take profit. Now the long block. The condition reads plainly. The candle pierced support, closed back inside above support, closed bullish, and printed a long lower wick. When all four are true, entry is read from the ask price. The stop loss is placed at support minus the buffer, and the take profit is the entry plus the reward ratio times the stop distance. Then send opens the buy. The short block is the exact mirror. The candle pierced resistance, closed back inside below it, closed bearish, and printed a long upper wick. Entry comes from the bid. The stop loss sits at resistance plus the buffer. The take profit is the entry minus the reward ratio times the risk, and send places the sell. Both sides share the same simple, symmetric structure. Let's bring this to life on the chart, candle by candle. Across the top you can see a red dashed line marking resistance, the supply ceiling, around 1.0900. Along the bottom is a green dashed line marking support, the demand floor, around 1.0840. Notice there's no oscillator panel here, because this strategy reads structured directly from price. We begin on the left, up near resistance. The first few candles drift lower, stepping down from the ceiling toward the floor. Each red candle gives a little ground, and by the fourth candle price is pressing right down into the support zone. This is where the strategy starts paying close attention. Look at that fourth candle carefully. It dips its low all the way down to 1.0832, poking beneath support, but then it snaps back and closes near 1.0851, back above the floor. That leaves a long lower wick hanging below the body. This is the rejection candle, the pin bar the strategy is hunting for. The low pierced the demand zone. The close came back inside. The candle is bullish, and the lower wick is more than half the candle's range. All four conditions agree. So on the next candle, the fifth, the EA signals a long, and the buy entry marker appears near 1.0851. The stop loss is tucked just below support by one buffer, and the take profit is projected upward at the reward ratio, the default 1.8 times the risk. Now watch price work in our favor. Candle 6 pushes higher, candle 7 extends the move, and by the 8th candle price reaches up to about 1.0897, where the take profit marker closes the long trade for a planned gain. That's one full cycle. A rejection at the floor, faded back into the range. Now the market does something interesting at the top. The 9th candle rallies hard and spikes its high to 1.0918, pushing above resistance, but then it fades and closes back at 1.0898, below the ceiling. That's a long upper wick, a bearish rejection candle at the supply zone. The high pierced resistance, the close came back inside below it, the candle is bearish, and the upper wick is long. The short setup is complete. The sell entry marker appears near 1.0898. The stop loss sits just above resistance, and the take profit is projected downward by the same reward ratio. From there, watch price slide. The 10th candle turns down, the 11th and 12th keep falling, and by the 14th candle price reaches the take profit marker near 1.0846, back down at the demand floor. The short fade has played out, mirroring the long. And just briefly, picture the alternative. If that 9th candle had instead closed firmly above resistance plus the buffer, the rejection idea would have failed, and the built-in hedge logic would have stepped in, opening a position in the direction of the break to participate in that move instead. That hedge is the strategy's safety plan for when a boundary genuinely gives way. And that brings us to the end of our look at the Dual Boundary Rejection Hedge. We covered how it maps support and resistance from recent swings, how it fades those boundaries on long wick rejection candles, how its stops and targets are scaled from the range itself, and how its built-in hedge responds when a boundary breaks. I hope this gave you a clearer picture of how price action structure and hedging can work together. Remember, everything here is educational information only and not financial advice, a recommendation, or a solicitation. Trading carries real risk, and losses do happen. If you found this helpful, please like the video, leave a comment with the strategy you'd like us to break down next, and subscribe for more MetaTrader 5 strategy analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.